Hello and welcome to this video on risk management in Forex trading. Forex trading can be a lucrative venture, but it's important to remember that it comes with risks. In this video, we will discuss 7 essential topics for managing risk in Forex trading. Before we get started, please take a moment to like this video so that it reaches more people who can benefit from this information. Watch this video completely so that you will be able to know how to avoid losses in Forex trading. Let's start with setting stop-loss orders. One of the most crucial risk management tools in Forex trading is setting stop-loss orders. A stop-loss order is a type of order that automatically closes a trade when the market reaches a specified price level. By setting stop-loss orders, you can limit your potential losses and protect your account from significant drawdowns. Let's discuss managing leverage in Forex trading. Leverage is a double-edged sword in Forex trading. It can amplify your profits, but it can also magnify your losses. That's why it's essential to use leverage responsibly and manage it effectively. You should always calculate your position size based on your account balance, risk tolerance, and the amount of leverage you're using. Now, what is position sizing? Let's take a look. Position sizing is another critical aspect of risk management in Forex trading. It refers to the amount of money you allocate to each trade based on your account size and risk tolerance. By determining the appropriate position size, you can avoid overtrading and minimize your potential losses. Diversification is a good technique. You should know about it. Diversification is a risk management technique that involves spreading your trades across different instruments, markets, and time frames. By diversifying your portfolio, you can reduce your exposure to any single trade or market and minimize the impact of unexpected events. You should learn risk-reward ratio to get more benefits. The risk-reward ratio is a key metric that traders use to assess the potential profitability of a trade relative to its potential risk. It measures the ratio between the expected profit and the potential loss of a trade. By using a favorable risk-reward ratio, you can increase your chances of success and manage your risk effectively. Keeping a trading journal, you should be aware of this. Keeping a trading journal is an effective way to manage your risk in Forex trading. A trading journal allows you to track your trades, analyze your performance, and identify areas for improvement. By reviewing your trading journal regularly, you can learn from your mistakes, refine your strategy, and minimize your losses. You should be sticking to a trading plan. Finally, it's crucial to have a trading plan and stick to it when managing risk in Forex trading. A trading plan outlines your goals, strategy, risk management rules, and trading rules. By following your plan consistently, you can avoid impulsive decisions, minimize emotional bias, and manage your risk effectively. Before we end this video, please take a moment to subscribe to our channel so that you don't miss out on future videos like this one. Also, join our Telegram group, which you can find in the description below, to stay updated on the latest news, analysis, and educational content related to Forex trading. Thank you for watching, and happy trading!